Welcome to Basics of Business Accounting, a concise lecture designed to give you practical clarity on core concepts and processes. Over the next few slides, we'll break down how accounting records, business activity, why structure matters, and how reliable numbers support better decisions, while keeping the explanations simple and immediately applicable for everyday use. This slide explains the double entry system, the backbone of accounting integrity. Every transaction records equal debits and credits, which creates automatic cross-checks to surface errors or suspicious items, and produces a clear audit trail that builds confidence among managers, auditors, and stakeholders by supporting accurate financial statements and timely reviews. Here we look at the accounting filing system and its benefits, where accounts are grouped into assets, liabilities, equity, revenue, and expenses. Organizing information this way improves departmental reporting, supports scalable software structures, and ultimately creates consistent financial visibility so managers can compare performance and make informed decisions across the business. Journal entries chronicle every financial event and form the source documents for the ledger. Capturing date, accounts affected and concise descriptions creates a searchable trail that supports ledger posting, variance analysis, and audit support. Disciplined journals help preserve transaction detail so managers can investigate differences and derive actionable insights without losing the original context. The general ledger process moves recorded journal totals into respective ledger accounts, where running balances and crossfoot totals are maintained to ensure integrity. From the ledger, we generate trial balances, respond to real-time accounting queries, and prepare monthly statements. This flow from journal to ledger to reporting is what keeps accounting accurate and useful for ongoing decision-making. A trial balance exists to confirm that total debits equal total credits, acting as an early check for recording errors before final statements are prepared. By revealing mismatches, it enables timely corrections that preserve the credibility of financial reports, supports reliable tax filings, and helps managers trust the numbers they use for planning and oversight. Net profit is the bottom line that shows what remains after cost of goods sold and operating expenses are deducted from revenue. Beyond the number itself, it highlights operational efficiency, pricing strength, and cost control. Stakeholders like owners, lenders, and investors use net profit to assess earning power and future growth potential, so it's central to performance evaluation. The balance sheet gives a point-in-time snapshot of assets, liabilities, and equity, and comparing sheets across periods reveals trends. Key checks include liquidity to meet short-term obligations, leverage to understand risk, and net assets for overall financial strength. Sequential comparisons help guide capital allocation, debt repayment, and decisions about retained earnings and reinvestment. Cash flow analysis separates operating, investing, and financing movements to reveal how cash actually enters and leaves the business. Operating cash flows shows core viability, investing flows indicate growth or divestment, and financing activity highlights capital structure changes. Together, these insights expose liquidity risks, funding needs, and inform strategic choices about dividends, borrowing, and reinvestment. Internal controls are the framework that safeguards assets and ensures accurate reporting. Segregating duties, reconciling accounts, enforcing authorization limits, and maintaining documentation all feed into a prevention and detection mechanism that deters errors and fraud. Strong controls protect physical and financial resources, preserve data integrity, and underpin reliable reporting for confident decision-making. Financial performance analysis focuses on a handful of key ratios and metrics: gross margin for profitability, current ratio for liquidity, return on assets for efficiency, and debt to equity for leverage. Computing these from raw numbers and benchmarking them against peers turns accounting data into actionable intelligence, helping managers pinpoint improvements and support sustainable growth. Cloud accounting brings automation, real-time visibility, and a strategic shift in how accounting supports the business. Automated bank feeds, invoice generation, and reconciliation reduce manual errors and closing time. Dashboards provide live KPI access, and this flow from retrospective record keeping to proactive strategic management lets finance play a forward-looking role in guiding the organization.